Hello, my name is George and welcome to my YouTube channel once more, and I hope this is going to be a very nice, educative and interactive session for this particular video. So today I want to take you through the three types of markets that you'll be seeing on your charts as a trader. This video is going to be both beginner friendly as well as intermediates. You're going to be learning a lot more from this particular video. You can be rectifying a few mistakes you've been making if you're intermediate, or if you're a beginner. This is going to be very much beneficial. So the types of markets. Now there are three types of markets we're going to be looking at in this particular case. Of course, we're going to be looking more onto one type of markets, digging deeper and deeper, but for this particular case we're going to just mention the three types of markets. I want you to guess the first one, the second one, and maybe the third one. Okay, maybe your guess was right. Let's see. Of course, we have the trending markets, then we have the choppy markets, and then we also have the ranging markets. So these are the three types of markets that are going to be looking at in this particular forex space. As now, we will start by ranging markets. So these are the three types of markets, and we're gonna look at them into details to try and see how best to trade them, how best to capitalize on them, and how to understand them when you see on your chart. Now, ranging markets. What are ranging markets? Ranging markets, basically, even from the name, sorry if my voice is a bit shaky. I'm having a flu, but I had to record this video because I had planned for it. Ranging markets are basically markets where price is trading within a certain range of prices. Okay, basically that is what ranging markets are. Basically, you're seeing price get to a particular zone, then come back to the same zone it was, something like that. That is what we call a ranging market. A market where price is just trading within a specific range of prices. So maybe, let's say for instance, this is gold price is just trading with between 2500 and 3000. So that is what we call a ranging market. So ideally you'll be looking out for price to see price get to this particular zone, take a buy to this up to this particular zone, take a sell down here, take a buy. You get that is ideally what you'll be looking at. And mostly people who trade the ranging markets are people who capitalize and trade on support and resistance zones. That is what you're calling now ranging markets. Now ideally, what I want you to know for this particular market is, number one, the more the price tests a specific zone or reacts from a specific zone, the more the chances of it getting violated the next time price gets there. Ideally, this is how I'd explain it in layman's language. At any given point in the market, there are orders. So for instance, here there are sell orders. That is why when price gets here, it starts selling. So there are sell orders. Now, when there are sell orders here, price gets here, takes the sell orders and drops, right? Price comes back, takes the sell orders and drops. So ideally what this means is that the sell orders are getting depleted over time. So that would mean that here again there are now becoming fewer orders. So ideally at this point you'll even be seeing more candles and price is really struggling to drop because there are not enough sell orders at this particular point. So that would mean, and that is why I've said that the more price tests a specific zone, the higher the chances of it getting violated. So ideally what you'll be looking for is or what you can expect now, the more price reacts from a certain zone is down, the next time price comes back here, we might see price violating that particular zone, and that will mean that again this one now will become your new support. Okay, remember in this particular case we are having these as your resistance and these as your support for this particular case. So ideally you're waiting to see to buy at your support and sell at your resistance. I hope that point is home. So I want you to always never forget that the more price tests a specific zone or reacts from a specific zone, the higher the chances of that particular zone failing to hold prices over time, because the orders are getting depleted around that particular region. So of course you can go on your chart, try identifying if you'll be able to see a lot of such examples, and I'm also going to be showing you a lot of examples to try and see a few examples, sorry, try and see how to apply these in the markets. Okay, so ideally when you're taking trades, when you're taking buys, you'll be able to take your buy from here. Of course you have to learn how to place your stop loss, and you're targeting that particular high. Or when you're taking your sales, you'll just be taking your sales, your sell opportunities from that particular resistance, learn how to place your stop loss and target that particular loss. Ideally, that is how you trade ranging markets. I hope that is understood. So the next type of market will be choppy markets. Now, choppy markets can be confused with ranging markets, but ideally choppy markets are markets with random prices. I'd say random prices, because now ideally these are markets that you cannot clearly understand what price is trying to do. Price is neither trying to buy nor trying to sell. Okay, so these are just choppy markets. Like you cannot, it shows. Oh, by the way, I've not told you that ranging markets, when you're seeing the markets ranging, it denotes that there is balance between buyers and sellers. Okay, balance between buyers and sellers. So ideally that is it. Now for choppy markets, now this one usually denotes indecision in the market, because ideally you'll be seeing market stretch up, get here, it's just doing random things that, like, there is no clear trend that you can say that price is trying to follow a certain or a particular trend. Price is just choppy. There's no point where you're able to say I can be able to check a trade from this particular point. No. So for choppy markets, we say when you're seeing a choppy market, you have to keep off. You do not have to trade for these particular markets. Anytime the markets are choppy, just take a stay off the market until you see a clear trend in the market. Then you can take a trade. And I've told you now, choppy markets denote indecision in the market. Okay, so after these choppy markets, of course, you're not sure if the buyers are going to gain control or the sellers are going to gain control. That is why we are saying stay off the market unless you know you're broken out of the choppy market zone. Do not take any trade on a choppy market. Now, trending markets, trending markets. Just from the name, these are markets with a clear trend. A clear trend. So basically that is it. Trending markets are markets with a clear trend. Now there are two types of trending markets. Of course, under trending markets we having number one, the bullish markets, and number two, the bearish markets, right? Okay, so those are the two types of markets you're having for this particular case. So for bullish market is basically a market on an uptrend market, a market that is creating for us something like that. And a bearish market is a market that is looking like this, a downtrend market, a market that is stretching lower and lower. That is what you mean. So ideally, we can say that a bullish market is a market that is creating for us a series of higher highs and higher lows. Higher high, higher low, higher high, higher low, higher high. That is the trend. Okay, and then the bearish market is a market that is creating for us a series of lower lows and lower highs, lower low, lower high, lower low, lower high, lower low, lower high. That is what you mean. Okay, of course we're going to be talking about now the structure of the bullish and the bearish markets, where we can be saying we're having a break of structure, change of characters, market structure shifts and things like that. On my next video I think we'll be talking about that, but basically that that is the second type of market. Now this one just denotes that there is complete, or there is control. Either the buyers or the sellers are in control of the market. Ideally, when you're seeing such, it means that the buyers are in control of the market. This one, the sellers are in control of the market. Of course, we're going to also learn about these retracements, why they have to be there, and yeah, of course they have to be there. You cannot say that now you do not expect to see an uptrend market just looking like this, just a straight arrow price just pushing higher, or a downtrend market just looking like this. No, there has to be balance between buyers and sellers. There has to be some equilibrium. Okay, so that is why you can see that price is looking like something like that. Of course, now we have to look at now our chart trend, see if we can be able to spot some of these particular markets. And I'd say now this could be our first example. You can see around here we're having this particular zone where price has really reacted off from. You can see this was the first The first time price got here, the second time, the third time. So ideally this becomes your support. But I told you guys that the more the times price reacts from a particular zone, the higher the chances of it failing. And you can see here the next time price was able to break below, and yeah, okay. So ideally that is that. For a choppy market, I want to show you guys an example of a choppy market. Okay, give me a minute. Of course, most of the times when you're expecting a choppy market, you'll be looking at a very, on the higher time frame scale, most of the times you cannot really see a choppy market. Okay, yeah, but on a lower time frame, it will be so easy to spot. Now, for instance, you can see what you're seeing on your screen. You open your chart and it's looking like something like this. You don't, there is nothing really you can understand from such a market. Okay, yeah, if it's mostly on a higher time frame scale and you're seeing something like this, it just means that the market is so choppy. There is a lot of indecision in the market. You're not sure who is going to gain control of this particular market, so you stay away of that particular market. And of course, now for bearish markets and bullish markets, these are things you can even see here. The market was so choppy, you're not so sure who is going to take control. Of course, we had this manipulation and then this distribution. We'll be looking so much into details about that. Yeah, and for bearish and bullish markets, ideally you can see, like for instance, this particular kind of market all the way from here to this point is a bullish market. You can see a high broken, another higher high, higher low, higher high, higher low, higher high. You get higher high, higher low, higher low, higher high. So this is structurally a bullish market. So basically that is it. I don't want to have you guys have a long video, so that would be a nice one. So you guys will just go on your charts now, try identify so many of those particular trends and markets, those three types of markets, and then in case you have any question, you can drop it on my comment section. But for now, until next time guys, I will let you rest. I'll see you on my next video, which is dropping soon, so make sure to subscribe to this particular YouTube channel so that you see more educative content dropping here and there. This has been George. I'll see you on my next video. Remember, you're just one trade away from your breakthrough. Bingo.